If you are a William O'Neill and or Mark Minervini style trader, a person who uses tight stops, 5 to 10%, or even less than 5%, then it is essential for you to watch the VIX, the Volatility and Fear Index. I've been investing since 1996, and I didn't start watching the VIX until about 5 years ago. I had no idea what the heck this wiggly line graph was, and I didn't care. But like I said, I started learning about the VIX and correlating it with my trading about 5 years ago, and my success rate, my batting average, if you will, has gone way up because of it. So in this video, I'm going to give you a Cliff's Notes version of how to use the VIX. And if you don't know what Cliff's Notes are, I'm jealous because that means you're a lot younger than I am. And then if you want to stick around, I found a great article here on what is the VIX and how to use it. And I'd just like to read this to you verbatim, maybe add a little insight. So first, the Cliff's Notes version. The Volatility and Fear Index measures volatility in the market, how likely there are going to be wide swings, and what we care about are swings down to the downside, big gap downs, big 3 or 4 or 5% moves down on no news, etc. If you are trading with a 5% stop, then a couple days of 3 or 4% down moves on no news is going to blow you out, right? It's going to cut you out of the market. You're going to get bucked off the horse, so to speak. And by the way, if you are a multi-year, long-term value side investor, then the VIX is probably not so important for you, but I think you'll still find this interesting. So to cut to the point here, what we should do as a tight stop trader is maximize our aggression, maximize the number of trades when the VIX is low, because that means that volatility is low and quiet, calm accumulation is taking place. And conversely, when the VIX is spiking, we want to be on the sidelines, we want to be in cash, or at minimum not initiating any trades or doing micro pilot positions. So you need to find a graph of the VIX. If you have stockcharts.com, and even if you don't, I think you can still look at it for free. It's $VIX. I'm going to show you the 20-year chart and the 1-year chart. So here's the 20-year chart of the VIX, and down here is the S&P 500. Basically, we want to be aggressive when the VIX is down here beneath 15. Like I said, when the VIX is below 15, for the most part, stocks are undergoing quiet accumulation. And if you look at, for example, from 2013 to 2018, much of this was quiet accumulation, a nice uptrend. And when the VIX was spiking, we had some radical movements in the S&P 500. Again, in early 2024, this year, we had great trading conditions, and this was reflected by the VIX, and sure enough, the S&P 500 was going up nicely. Let's look at, wow, sorry about that. It's allergy season. 2004 to 2007, again, for the most part, we were down here in the green zone, and we had a nice period of quiet accumulation in the VIX. Conversely, once we got up here above 20, we saw the market start to fall off. So green means go, 15 and below. 20 to 15 is kind of trade with caution. Above 20, you gotta be you should be thinking about shorting, thinking about being in cash, thinking about protecting positions, micro positions if you decide to try the long side. And then a big spike way up here generally means that we are at the bottom. Okay, now in just a second, let's look at the 1-year chart of the VIX. But remember, the VIX is a secondary indicator. We do not trade purely on the VIX. Oh, the VIX is low, I'm going to close my eyes and buy 100 shares of Apple or what have you. The charts are king. The VIX kind of shows you what season we're in: summer, fall, spring, winter, and then the charts, of course, tell you when to buy. Let's roll down to, oh, that's not the 1 year. And by the way, I'm showing, these slides are from my Patreon. I have a Patreon service. I show my portfolio and focus list and some secondary indicators every weekend, and I do a video midweek usually, or blog post. There's a 7-day free trial. You might want to check it out. Link in the description below. Now, here is the VIX. Zooming in on the 1 year chart. I like to look at both of these. I like to look at the 1 year chart every day, and then I check in and look at the 20-year chart every weekend. And if we just rewind a few months, you may recall that we had a pretty nasty downturn the second half of 2023, and sure enough, the VIX spiked out of this green calm time period and rose significantly, and then this spike showed us we were near the bottom. And then we had a really nice bull market run from November to April or so, and look at how quiet the VIX was. And then we've had this multi-week pullback, what was it, 7% or something, and see how the VIX elevated. So when I see the VIX come out of the green zone into the white zone, in this case, I usually make it yellow. That's a signal to me to start being more cautious. And when it gets up here above 20, that's a signal to me to pump the brakes big time. Now, that doesn't mean I liquidate all my positions, but that just means that make sure I have tight stops and alerts in place, and I don't take any trades unless they are absolutely perfect. Okay, now hopefully you're still with me, and if you are, let me read you this article on what the VIX is and how to use it. A lot of the thoughts that I just mentioned will be presented to you more eloquently. And if you haven't liked the video, maybe you could like the video. All right, this is an article by Rebecca Caitlin on Forex.com. The title is, "What is the VIX Index? How to use the Volatility Index in your trades." The VIX is one of the most widely used measures of market volatility for both the S&P 500 and wider stock market. So what is the VIX? How is it calculated? And how can you take your first position on volatility? All right, so here's her introduction. What is the CBOE Volatility Index, aka the VIX? The CBOE Volatility Index, more commonly known as the VIX, is a real-time index that tracks the market's expectations of changes in the S&P 500s. So it's a real-time index, to repeat, that tracks the market's expectations of changes in the S&P 500. It's an important benchmark for market risk, stress, and sentiment, which is why it's often called the fear gauge. It was introduced in 1993 by the Chicago Board of Options Exchange. It's grown over the years. Its calculation methodology has been altered to create a broader market benchmark and more accuracy. So, how does the VIX work? The VIX works by tracking the price of at-the-money SPX options with near-term expiration dates. This means it's not a representation of the price of the underlying S&P 500 itself, but of the price traders are willing to buy and sell the S&P 500 at for the next month. The more dramatic the price swings in the value of SPX options, the higher the levels of market volatility, so the higher the VIX value. This part is a little boring. I might skim through some of it, but let's see. SPX options are a combination of standard SPX options that expire on the third Friday of each month, weekly SPX options that expire on all other Fridays. To be included, an option must have an expiration date between 23 and 37 days from the time of calculation. All right, I guess I didn't skip that. The VIX calculations are complex, so put simply, the index takes the values of all of the put and call options over a range of strike prices, deduces the market's perception of which strike prices are likely to hit before the expiration date from how much people are willing to pay for each option. It's calculated in real time. All right, what does the VIX tell us? And by the way, I'll link this, I'll put a link to this article in the description in case you want to read it on your own. So what does the VIX tell us? The VIX tells us the market's expectation of volatility rather than current or historic market levels. However, it is considered a leading indicator for the wider stock market. So that's kind of a holy grail, right? We don't want to see what's happening in the past. We want to know what's going to happen in the future. And we do not want volatility in the market. We want calmness. We want predictable price moves. A common mistake when reading the VIX is that it tells us whether the S&P 500 is being bought or sold. While the VIX and S&P 500 do usually have an inverse relationship, the VIX is a measure of volatility itself. And in theory, these price movements could go both ways. And yeah, you see that when the VIX is spiking way up. Often you'll see wild swings down and then wild swings up. But we can't, as a low risk tight stop trader, we really can't take advantage of that. Like I said, we need price predictability. And there, like she said, it's generally inverse. When the VIX is going down, the S&P 500 and the general stock market, for the most part, is going up. Okay, what else? Okay, another misconception is that VIX levels have an exact relationship with volatility seen 30 days later, when in reality the VIX level is often slightly above or trading at a premium to the actual volatility. This is because when the time comes around, the market is usually adjusted to the volatility. So how do you read the VIX? The VIX is presented as percentages, so the index fluctuates between 0 and 100. Much like a typical oscillator, you read the VIX using known levels of support and resistance. Now, hers varies just a little bit different than mine. She says below 12 is low volatility. Anecdotally, I have discovered that a VIX beneath 15 or below is where I can consistently be successful as an O'Neill/Minervini type trader. And then she says between 12 and 20 is normal volatility. I think, like I said, I do 15 to 20 is kind of use caution. And then she says above 20 is high volatility, dangerous trading conditions. I would definitely agree to that. Although when you're up there above 20, if it gets pegged above 20 for a while, that can be really easy shorting conditions. There's a mantra: when VIX is high, it's time to buy. When the VIX is low, look out below, which is used to describe these support and resistance levels. And I would say that a spiking high VIX often indicates that we are near the bottom, but not always. The VIX can stay elevated for weeks or months. And I disagree with when the VIX is low, look out below. Like I said, I've had great success trading in low VIX traditions. Some of these old sayings, like sell in May and go away, perhaps at one point they were true, but anecdotally, I don't see accuracy in them anymore. All right, what does it mean when the VIX goes up? When the VIX goes up in value, it means the price of the S&P 500 is likely falling. The value of SPX put options are increasing. Analysts interpret these high values to mean that investors are uncertain or fearful about the stock market, hence the fear index. The theory goes that when there are high levels of volatility in the market, a bottom or support level has been found and the market is going to change direction. This is why the common action is to buy when the VIX reaches high levels. Now, let's improve that by saying when the VIX is at high levels, that's when we get ready to buy. When we see breakouts out of well-formed patterns or bullish engulfing days, candlestick bottoming patterns, etc. We never close our eyes and buy or sell because of what the VIX is doing. What does it mean when the VIX goes down? And the VIX has been falling the last few days here. When the VIX falls in value, it usually means that the price of the S&P 500 is rising in price or experiencing relative stability, leading SPX options investors to pursue bullish or neutral strategies. So a falling VIX is good, unless you're short. Analysts would interpret these low to middle values as a sign that the market is experiencing little stress or concern. Low VIX values are often bearish signals and lead to market participants closing their positions. I don't know if I don't really agree with that last sentence. How do you use the VIX? Okay, so I kind of gave you my Cliff's Notes version earlier in the video. Let's see what she says here. You can use the VIX as part of a trading strategy, as it can give indications of whether the S&P 500 and stock market in general is going to reverse from its current trend. As mentioned above, when the VIX hits highs, it is often seen as a time to buy the market, and when it makes lows, it's seen as a bullish signal. However, this strategy should be taken with a wider methodology of technical and fundamental analysis to confirm entry and exit points. Yeah, that's what I kind of just said. It's important to know that the VIX can remain above or below these levels for significant periods of times. So the signals it gives off might not necessarily indicate an immediate reversal. For example, this is a great example. When the COVID-19 pandemic hit in early 2020, the VIX climbed higher than 80, level it hadn't experienced since the last financial crisis in late 2008, and it took the VIX till December 2020 to fall below 20 again. And I was trading during 2020, and there were a bunch of juicy trades that started, I believe, in about March 2020, as soon as the Fed made that announcement that they'd do anything they needed to do to prop up the market. So we had a strong bull market in 2020, starting in March, and the VIX didn't come down below 20 until December of 2020. So the VIX is a secondary indicator. Like I said, let the charts be your guide, and the VIX kind of tells you what the weather is likely to be, what season we are in. The key thing to remember is just that the VIX and the key thing to remember is just that the VIX and the S&P 500 have an inverse relationship. So when the VIX is rising or falling, the S&P 500 will likely be doing the opposite. We want a falling VIX, and we want a VIX below 15. You can also trade the VIX directly, and honestly, I don't know anything about that. I think there are some ETFs that mimic the VIX. I've never researched that. I've never had an interest in doing that. I just trade stocks directly. I just did a quick search here with my partner 𝗕𝗨𝗬𝗠𝗆 and looks like here's a low volatility index ETF, here's a high dividend index ETF, US small cap low volatility index. Like I said, I don't know anything about these VIX related ETFs, but I will tell you that this my partner 𝗕𝗨𝗬 Premium is an amazing resource for all kinds of things. You can have a real-time portfolio here. Here's some of my open positions in stocks that I'm watching, and you can sort them, of course, by percentage change and so forth. And then if you click on one, Kava is probably my highest conviction stock right now. You can dive into the fundamentals here with all of this financial information, and you can read analysis articles. Ooh, these guys are saying sell. That's I don't like to see that. Maybe I'll, after the video, get on here and read some of these articles. You can read the latest news items, transcripts, and then also on Seeking Alpha, you can subscribe to 𝗕𝗵𝗵𝗪 quantitative based portfolio, which is handily outperforming the S&P 500. I encourage you to check those out in the description of this video. Let me know your thoughts on the VIX, particularly if you know anything about VIX ETFs that you've had success with. Maybe you could educate us on that. Any other opinions on how you use the VIX? So in summary, keep an eye on the VIX. When we're below 15, life is good. 15 to 20, use caution. Above 20, be very, very careful. The market is coming down, and a big spike often indicates we are at or near the bottom. Take care, everyone.